inflation, and rising interest rates. Is a recession coming? Not in the cards, according to Golden Eagle Strategies. Welcome to the Golden Eagle Eye on the Market segment featuring macroeconomic and stock market commentary for the data-driven investor. We have Robert Zuccaro with us today, founder and CIO of Golden Eagle Strategies. Robert manages a strategy predicated on statistical analysis and principles derived from more than 40 years of research. He is a quant pioneer driven by a never-ending pursuit to identify the common threads of top-performing stocks in pursuit of superior performance. Robert, there are a lot of things that people are really concerned about these days. What is your perspective around the war, inflation, and interest rates? And are we headed into a recession?
As you mentioned, investors are concerned about war, inflation, interest rates, and recession. Since 1940, there have been 18 major geopolitical events, many involving war. The U.S. was bombed at Pearl Harbor on December 7, 1941. It took the market 1 year to recover. After it went down, after the Cuban Missile Crisis in 1962, it took just 2 months for the market to recover. On average, for these 18 geopolitical events, the market has recovered 47 days from the onset of these events. So the Ukraine war is somewhat serious. It's causing economic dislocations throughout the world, but the United States, of all countries throughout the world, is best positioned to deal with this war, which more than likely will come to a conclusion over the next few months. On inflation, we published and sounded the alarm almost a year ago in July last year, an article that we published stating transitory inflation is wishful thinking. Since then, the rate of inflation has continued to ratchet up. The recent report on the CPI puts it at 8.5% annual rate. Our work shows that inflation is actually understated as reported by the Department of Labor, and it's a serious problem. Most commentators look at the causes of inflation as being supply bottlenecks and the onset of the war, which started in February, but inflation was escalating at higher and higher rates well before the war started. The real culprit behind inflation and why we think this is a years-long problem, it's not transitory, it's embedded into the U.S. economy for this reason. From the end of 2019 through 2 months ago, the money supply, M2, which means the aggregates of cash and savings accounts, expanded over less than 2.5 years by an unprecedented 42%. And it expanded at one period at a far faster rate than in any year during World War II. This is the real catalyst behind inflation, and it's the reason that inflation is not going to come down anytime soon. But American business is ingenious. In the 1970s, they adjusted the very high inflation, which crested at 13.3% in early 1981, and continued to make adjustments in their businesses in order to improve corporate profits. The same thing will occur this time around. Inflation's interest rates are a cause of concern, and what we fail to keep in mind in addressing rise in interest rates, and the Fed now has raised rates twice after holding rates steady for many years, is that we are starting from a base of historically low interest rates. And there is more than ample room for the Fed to raise rates in order to dampen economic activity. If you look at the long term, the average yield on a 30-year Treasury bond has averaged 4.5% over the last 4 years. We are now at 3.2%. And again, interest rates are not a problem. They will go higher. They must go higher in order to dampen economic activity, bring inflation under control, but they do not pose a major threat to the U.S. economy. In terms of recessions, I don't know why people are talking about recessions. They're talking about inflation, rising interest rates, wars. There have been 52 business cycles since 1854. 3 of the 4 business cycles have occurred in the last 4 economic expansions. The 1990s witnessed a 10-year expansion, followed by a recession, followed by a 5-year expansion in the early 2000s. The last economic expansion from 2009 to 2020 was the longest on record, lasting nearly 11 years, and would have gone on longer had it not been interrupted by an exogenous event, the pandemic. Those people that are talking about recession means that if we're going to have a recession in the next year, it's going to occur within 3 years of the start of the last recovery. I do not think that's in the cards because of government stimulus. The economy has been overstimulated. In December of 2020, in the Trump administration, Congress passed a stimulus bill of $2.3 trillion. 2 months later, 60 days later, the incoming administration passed another stimulus bill, one calling for an ancillary $2.1 trillion, correct that, $1.9 trillion under the American Rescue Plan Act. Clearly, there is too much money in the economy at the moment. However, consumers are flush with more than $1 trillion in cash and savings account that at some point will find its way into the saving stream. So the way that we look at it, and most people fail to recognize that the stock market is a leading indicator, typically turning 6 to 12 months before a turn in the economy, either up or down. They look at the current news and they equate it with the current stock market. The stock market does not work that way. More than likely, it has discounted a possible but unlikely recession over the next 12 months. In our view, we think we are at the low point in the market, and by year end, the economy will still be expanding and be looking at a higher stock market.
Thanks, Robert. What are the key takeaways for investors?
Key points: the profound expansion of the money supply, which few people are looking at, which means that we are going to have persistent high inflation. Second, the war is disruptive, but it's not going to determine, to a great extent, American economic activity. The American economy over the past 5 and 10 years has been done better than any of the stock markets and economies throughout the world, and that will continue. The bad news is behind us in the stock market. The Nasdaq's down 30%, the R2000 down 21%. And recently, a couple of days ago, the S&P was flirting with being down in bear market territory, almost 20%. Now, this is important. No one knows which way the next 20% move in the stock market will be. But everybody knows which way the next 100% move in the stock market will be. Our mantra is that bear markets are temporary. Don't worry about them. Don't panic, don't do anything differently, but the bull market is permanent. I'm going to give you some additional information for thought. I don't think investors should own bonds. I think bonds are a silly component of the portfolio. If you bought a 10-year bond 10 years ago, you would have had a coupon of 3.2%. Over 10 years, how much did that coupon change? It's fixed. It's a contract. 10 years ago, the S&P 500 was paying out $23 in dividends. Last year, it paid out $57 in dividends. That's a bump of 146% and a very compelling reason to own stocks because there's growth in profits and growth in dividends. Profits go up on average for every 5 years, and dividends accompany growth in profits. So you have intrinsic growth in profits and dividends, and that's because of the ingenuity of American businessmen and women, both corporate people and entrepreneurs. And we have like 20 million small businesses in the United States, which account for half of economic activity, and the other half is accounted for by corporate America.
Thank you for joining us today for Golden Eagle Eye in the Market. For more information, visit our website at www.goldeneaglestrategies.com. Please note, the thoughts expressed in this podcast are those of the presenter. This is not, nor should it be considered, an offer or a solicitation of an offer for investment.